Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, founder and owner of Menninger Associates Financial Planner. I'm here with one of my associates. Your name's on the door too. It's Kyle Ryan, also a certified financial planner, chartered financial consultant, and as also the highest equity owner as a junior equity owner. Basically, he's a business partner here. So, Kyle, thanks for joining.
Thanks for having me again.
This is the second part of, actually, it's the sixth. Yeah, we're in a sixth one. We're on the sixth episode of various questions and answers that were captured from the internet off of artificial intelligence. We specifically asked, hey, ChatGPT or whoever the heck it is that we did, give us questions that people are commonly asking about financial planning. What we then did is we took the questions, we categorized them, and the first 4 episodes were on general Q&A, retirement planning, debt management, and then risk management / insurance planning. The 5th episode was the part 1 of this one is investment questions and investing. So we're on the second one. The last episode, we spent most of our time talking about the difference between stocks, bonds, mutual funds, ETFs, risk management in the form of allocation, asset allocation, and diversification. So we'll pick up here with more questions. Obviously, they're going to be related, but the very first question is, should I invest in individual stocks or index funds?
That is dependent upon your risk tolerance, I would say, and what your interests are. So when I start working with someone who's never invested in the market before, it's proper to have the majority of your money within some sort of mutual fund, a well-diversified fund, or funds, right, to build a proper portfolio. But if you're trying to gauge interest and really, have some psychological benefit, when I sit down with some people and when they first start investing, like, name a company that you really enjoy. I go shopping on Amazon. I go to Disney. You name it. We'll do a little bit, like not a lot of money, a little bit into that money, unless we think it's a good company. But that's where, do you invest in stocks, individual index funds? It really comes down to the amount of risk and interest you have. You don't buy a stock if you're not going to look at your investment account for years and just check in on it randomly, because what if something happened with the company, you didn't see it in the news and it's cratering and you could have gotten ahead of it? So my rule of thumb is usually for more aggressive investors. If you are conservative, typically I'd say don't own stocks. It's not worth the
individual stocks.
Individual stocks if you are very conservative. If you're a rather aggressive investor, I've got people with Roth IRAs, 20, 30s, 40s. They don't need the money for a long time. I kind of use a rule of thumb, 80%, 70, 80% to be in mutual funds, ETFs, nice balanced funds, whereas the other 20% to 30% can be in individual stocks. But we're not picking high flyers. We're picking blue chip stocks, these large tech companies, nice dividend paying companies. Sometimes we'll take risk, but never is one individual stock more than about 5 to 10% of the account. Usually no more than 5% to start. If it grows, great, we did well. But what we want to do is we want to look at that and take action, say, hey, this stock position has grown. Maybe we don't want as much of it anymore. We'll trim it. Or maybe you bought it at the wrong time and it's down. You want to add more to it. But really it comes down to, I think it's just your risk tolerance and what you're interested in. And don't, put all your eggs in one basket again in the form of one individual company making up a large majority of your portfolio.
Right. And so going back to what we talked about in the prior episode, long and short of it is that an index fund or a mutual fund diversifies and spreads out your risk. So an individual stock, you can hit a home run, but you can also strike out.
Yes.
And to Kyle's point, if you're going to buy individual stocks, I'm okay with that. Don't overweight one particular stock and keep an eye on it. It's all you know.
That's it. Keep an eye on it. Things change.
You also pointed out, and common client Dave always said, look, I'm going to buy a stock in a company that I know.
Yeah.
I use Amazon all the time for shipping and buying packages and everything else like that.
It's fun. It's like, I'm contributing. I'm getting a little back.
Well, yeah, you know what? Exactly. I'm getting some of my
getting a little
money
bit back.
So anyway, and they do that. We go to Disney every year and we think it's a great deal. We like Disney, and we buy in that. So it's what makes you feel comfortable. Or you may be a technology person and say, hey, you may know a lot about, I use all the Apple products. I'm the one who has the iTunes, iPhone, iEar, iNose. I got everything that's Apple, and then it's like, hey, you know what?
We work with a surgeon who uses a specific medical device company that they absolutely love, and they're like, we want it, and sometimes we're financial advisors. We can't study every single company that's out there. Sometimes you work within a company or you have exposure to it through one reason or another. You might have some good insight where we could take that and look further into it to identify it. But again, all comes back to balancing risk, right?
Correct.
Even as confident as you are in a company, it's really important to have that diversification.
Okay. So next question is, how do I know if an investment is right for me? Kind of a loaded question.
If you know if an investment is right for you, I don't like that question.
Yeah, I don't like that question either. Well,
If it grows for you, well.
right, exactly. And it's funny because how do I know? This is admittedly because way back in the beginning, before I became a financial advisor, I was in the engineering industry. What most people do is when they look at their 401k and they're given their options, what do? You look at the last 1 and 3 years to find out which one performed the best. Those are the ones you pick.
Yeah.
And that's not necessarily the right thing to do. So what is the right investment?
It's if you really wanted to drill down into it, you'd have to do some analysis of what the stock, the bond, the ETF mutual fund is. Not that you'd look at historical performance to indicate future results, but it is kind of telling sometimes if you look at a stock fund, you look at how it did in 2008, how it did in down markets, how it performed in up markets. You have the same management company. You can kind of get a sense of, okay, I see that it did really, really well in the up years and really, really poorly in the down years. That's an aggressive fund. I feel comfortable with that. Or you might say, whoa, I love my 80% up years, but I'm not taking a 40% down year. Then, it really comes down to understanding the risk profile of the investment you're getting into and whether that fits your risk profile.
Perfect. That's actually what I was thinking about how to say it. So next one, I'm going to give you this one. What are alternative investments? Actually, I'll start it. How about I read the question first? All right. What are alternative investments like real estate or commodities? Now, I'll answer it and you can pick it up from there. Basically, these are generally real estate and commodities are the two that they reference as alternative investments, although there are a multitude of other wacky things that they kind of constructed and synthesized. But the whole idea is the alternative investment does not behave the same as stocks or bonds. Now, think back and step back for a moment. There's 3 basic asset classes: stocks, bonds, cash. Cash being CDs, money market, and things along that nature. Stocks and bonds. Well, stocks and bonds typically have a negative correlation. When stocks are doing well, bonds aren't. When stocks are doing poorly, bonds are doing well. So they have what's referred to as a negative correlation. But real estate and commodities are considered to have zero correlation to stocks or bonds. So that's why they're considered to be alternative investments. So for instance, bonds can almost inevitably go down when interest rates are rising. That's not going to have an impact on real estate, and it's not going to have an impact on commodities, except if it's a fundamental economic thing that's causing the one thing to happen, but they're basically independent.
Yeah, there's a lot of non-correlated types of alternative investments. I mean, throw one out of the woods. You can invest in art. Art's a collectible. You can invest in cars. Cars are an alternative investment. Your home is real estate, right? So it kind of, again, it all centers from a point of diversification, right? When we look at a balance sheet, which comprises your assets and your debts, and I see 0 investment accounts, 18 properties, exaggerating.
Yeah, which is
That's poorly, you have a lot of risk in the real estate market. If you have all investment accounts and no real estate, no home or anything, you don't have any exposure there. There's art, there's precious metals, right? And how do you go about buying these? What is the risk and reward, right? A lot of these alternative investments are at a loss of liquidity, right? If you go and you want to diversify your investments by purchasing real estate, well, you can't just go buy a rental property or whatever and sell it the next day. If you go and purchase commodities such as precious metals, how do you own it? Do you have it stored? Do you have it, and if it's stored somewhere, you're paying maintenance fees, you have to, take time to go and sell it to someone, or are you trading like gold futures or something like that, which is highly liquid? So there's a lot of different ways that you can diversify within alternative investments from the norm, but it comes down to your liquidity needs, what you're seeking from a return perspective. It gets a little bit complex because the world opens up. You can go into private equity, right? A lot of companies, we're talking about stocks before, we're talking about public stocks. We as a company have stock. It's a private stock. It's a different kind of stock, but there are ways that, as an angel investor, or venture capitalist, you've heard of these. There are ways that you can invest that isn't just in the traditional markets. Is effectively how I describe alternatives.
To better explain commodities, commodities are gold, silver, copper, cocoa, orange juice, pork bellies.
Price of cow.
Right. Well, and so those are all the things in the commodities market, all the different things. Maybe the movie Trading Places. I'm not sure if you saw that.
Behind me before me.
That was a great movie, actually. So it's like, corn prices, cocoa, coffee, gold. Those are all commodities.
Tend to be more inflation resistant. So gold increases during inflationary environments. So one thing that you'd see where people in times like 2022 when inflation was on the rise, that's where people were more apt to buy treasury inflation protected securities, right? That's another alternative investment. Things that go up with inflation. Commodities go up with inflation. There's times that commodities can bode well for you depending on the market that they're in.
Okay. Yep. Beat that one to death.
Yep.
All right, well, I'll tell you what, that actually probably serves as a good time to take a short break. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained as we continue on the second episode of investments. And we spent a lot of time talking about ETFs and stocks and bonds and everything else in the prior episode. In the first segment, what we talked about, the various different, what was it?
Less than normal
You're right.
investment options.
Exactly. Anyway, forget what we talked about the first segment. Obviously wasn't very memorable, but be that as it may. All right, so here we go. So next question is, what role do bonds play in my portfolio, especially in times of market volatility?
There's one word that comes to mind for me. It's I think a word I learned in the industry, ballast. Ballast is the best way I could describe it. Ballast is basically providing, in times of volatility, stocks are going down, stocks are going up, bonds are going up, bonds are going down. Typically, it'll smooth out your performance a little bit. Stocks are down, bonds historically are negatively correlated. You'd think they'd be up, which could balance out the performance, right? Same way on the upside. If bonds are down, stocks are up, provides ballast, and it kind of middles out your performance a little bit more.
Yeah, because of the fact that bonds don't move nearly as much. Yeah. And to your point, there's a negative correlation between stocks and bonds, meaning that when one's doing well, not necessarily up versus down, doing well relative to its, doing poorly relative to its, except if there is a external stimulus which is causing everything to cave in. And I will give you three of them that occurred in the last 20 years. One of them was 2008, the global financial crisis. Everything went south in a hurry. Okay.
Bonds held up well during that time, right?
No, not during the late part of 2008. They held up to the collapse of Lehman.
Yep.
And it was after that all of a sudden it collapsed. Okay, you lost 20 to 25% in a very quick period of time. Yep. So sometimes you'll have an external stimulus that causes everything to collapse at the same time. Bonds rapidly came back. Believe it or not, they came back faster than stocks, because I remember in 2009 looking at a portfolio, how did we do year to date? And actually bonds did better than stocks on the upside.
And could it have had something to do with interest rates?
It had nothing to do with interest rates. Yeah, there's nothing. It was all because people sold bonds, and it caused them to go down. It was fear. It's all fear. Everybody sold everything. That was the first one. The second one was COVID. Okay, there was a 5-week period where stocks lost 35%. 2 weeks later, all of a sudden, bonds lost 25%, because quite frankly, when we were in the throes of COVID, late February, early March, we had no idea what was going on. No. And there was fear, and everybody was selling everything, and that was creating selling pressure, which caused everything to go down. And then the last one was 2022. Stocks had a bad year, bonds had a bad year, but that's also because we had massive inflation. Inflation caused interest rates to go up. So the interest rates going up destroyed bonds. The inflation and interest rates going up hurt stocks, but came out of that, stocks snapped back. Bonds have been slowly coming back and still haven't recovered from their losses from 2022.
And correct me if I'm wrong, but 2022 is the worst year in history for a balanced portfolio.
Oh yeah, that's
Recent
right.
history, right?
That's
And a
correct.
balanced portfolio is what's referred to as 60% equities, 40% fixed income or bonds. So, when stocks in 2022 were down to the tune of 20-ish%, bonds were down to the tune of 13%.
Correct.
I mean, you don't expect your bonds to go down 13%, right? We're talking about ballast, diversification here. You don't really, a bad year for bonds historically, 4, 5, 6% would be tragic. 13%. I mean, that's a event like Mike mentioned. Inflation's rapidly rising, interest rates are rapidly rising, geopolitical concerns. Let's not forget Russia invaded Ukraine that year.
Right.
There was a lot going on, a lot of reasons that people were panic selling, even the bonds, which are typically going to hold up in that environment, but the interest rates absolutely crucified them.
Absolutely was. And for what it's worth, exact numbers is, bonds have lost 4%. We talked about instances where they've lost 15% or 25% in a 3-month period, or through 3 weeks, whatever. But the worst year, they've been monitoring the bond index, which is the aggregate index, since 1976. The worst year, other than 2022, going into 2022, the worst year ever was minus 3.4% in 1994. So to take a minus 13%, that's a beating. Yeah. That's a big beat.
That's why when I think of 2008, I'm like, they held up pretty well if it wasn't 2022.
No, because of the fact that during
they recovered
the
in the calendar year.
Well, the front 10 months weren't down. So it went down off its peak.
Yeah.
But it didn't get hurt for the whole year. So, but yeah, I mean, they got crushed because of the fact that interest rates leading into it were extremely low. So even though interest rates jumped more than they jumped in 1979, 1980, in 79, 80, when interest rates went from 14 to 20, that's a 6% drop. These went from basically 0 to 5. That's only a 5% jump, but relative to zero, that's a lot. Okay. All right, next question. How can I take advantage of employee-sponsored retirement plans? Oh, boy, we have episodes just on that.
Yes, we do.
But anyway, so how do you take advantage of it? Well, again, this is investing 101. It's a great opportunity for you to make contributions. In fact, I talked to somebody this morning about this. They just joined a job and they said, what should I do? I got this 401k here. Well, in this particular instance, they didn't have a company match, but that's because they work for a school district. Most school districts don't because they have the pension. So in this particular instance, it was that, but still, what we always recommend is make the contributions to your company retirement plan. Number one is if they're matching, you're foolish not to, because that's free money. So
I saw the statistic. I believe a 3% match is equivalent to 2 weeks worth of pay in a given year.
Oh, really?
Yeah.
Okay.
I'd have to do the numbers again. But yeah, if you just put 3% in because you're getting a 3% match, that's effectively they're paying you another 2 week.
Right. So actually a week and a half. Think about 3.
There you go.
Yeah. So anyway, the other thing it does is, this is behavioral finance again, is pay yourself first. Okay. So what happens here, if I said, hey, Kyle or whomever, go save $500 a month. You might try to do it, and it's so easy to say, I'm not going to do it, or I don't have the money this month, and so on and so forth. But what you do is, if you do it through your employer, what's happening is that it's being withheld from your paycheck before you see it, because history has shown people spend what they take home.
Yes.
Okay? And if you're going from $50,000 to $60,000, those first couple paychecks are great. The next thing you know, you're living on $60,000. You go from 60 to 80, those first few paychecks are great. Guess what? You're living on 80 grand.
Yep.
And that's just what we've seen. So what we recommend is make the contributions, and every time you get a pay raise, take a portion of that pay raise and increase your contributions, because let me tell you something, particularly if you're young, this is going to make the world of difference when you're in your mid to late 50s, because all of a sudden you've accumulated potentially over $1 million in your retirement plan because you've been accumulating it all these years. And it can make the difference of if you get laid off, you lose your job, or choosing to retire, whether it's because physically you can't do it or just flat out don't want to do it. Making these contributions to your retirement plan at work is terrific because it comes out before.
To your point, compounding interest, say, is the eighth wonder of the world. It's out of sight, out of mind. You know, if you're putting in 3%, 4%, 6%, it might be 80, it might be a couple $100 of your paycheck, depending on how much you get paid. But you notice that a lot less when, to your point, when it comes out, you never see it. You only see it on your pay stub. Your net take-home pay, if you're investing $100 a paycheck, you're more likely, if you're going to do it before you get paid, than taking your pay and saying, now I'm going to invest $800.
Right.
Just a psychological trick, and it really, really pays off over time. One thing about how to not take advantage of an employer-sponsored plan, we've seen this. Don't invest it in cash for all those years. Just check in on it every now and then. Don't have it sitting in cash for a long period of time, or
we've seen it.
Arguably any period of time. But yeah, we've seen it before where people have cash for years because they didn't want to take the risk and
Forgot,
never look back. So that's how you don't take advantage of an employer-sponsored plan, by not contributing up to your match at least and not investing it.
Right. Next one. Oh, I like this one. What is dollar cost averaging strategy and should I use it?
If you have a 401k, you're using it.
That's correct. So dollar cost averaging is kind of a mathematical phenomenon where if you were to invest the same dollar amount at multiple times, what happens is that when the share price is high, you're buying less shares. When the share price is low, you're buying more shares. And as a result, mathematical phenomenon again is that if you add up and take the average of the share price, let's say we took it on 5 different dates. You take the average of the share price that you bought on those 5 different dates, and we take the amount of money you invested in the shares that you have, your average share price is lower through dollar cost averaging. Now, you're automatically doing it in the 401k because you're contributing every 2 weeks, twice a month, or whatever your payroll schedule is. You're doing it automatically. But one of the other things about dollar cost averaging, and we do it with our clients, who someone drops $100,000 in or whatever, what we do is we do dollar cost averaging because it takes the emotion out. If you followed your emotions, you're usually going to lose.
Yep.
And, like, oh, the stocks are high, I'm not going to buy them, or whatever, or they are high, I am going to buy them. They're low, I don't want to buy them. It's the absolute opposite, buy low, sell high.
Yep.
And so what we do a lot of times is we'll take someone's money and we'll dollar cost average twice a month. So we use that $100,000 example. What we'll do is we'll do $10,000 twice a month for the next 5 months, and we're leaking into the market. Now, I've personally used it. If I said I wanted to buy ABC stock and I see that it may or may not be a good price, but I want to buy it as it goes down, what I'll do is I'll pick a dollar amount. Let's say I wanted to invest $50,000 into it. What I'll do is I'll put $10,000 in at today's price, and then I'll pick various prices in lower. And rather than saying, if it was $100 a share, that's 100 shares at 100 is $10,000. But I want to put $10,000 in at 90 a share means I'm buying 1,100 shares.
Yeah.
11 shares. And if I say it at 80, I'm buying 125 shares. So what happens is that you're buying more shares. And it just so happens that every once in a while you're going to have it dips down, and woof, you start picking up all these shares. And if it comes back up again, all of a sudden you bought all these shares at lower prices.
It's a real psychological trick. There's a lot of math that goes behind it, but the psychology can apply in a lot of different ways too. That's one thing when you have cash you want to invest, right, into a specific stock or fund or whatever it is. Say you're looking at someone, we see it all the time. You've got 100, 200 grand in the bank, and you're like, it's burning a hole in your pocket, not literally, but you're like, I want to invest this. Well, you've saved over all those years. You built up those cash reserves. You're less likely than to just take a huge chunk of it and go take all that risk in the market now when you've been taking cash. So it's a way that you can walk before you run and getting investment exposure with things like cash. Take it a step further. If you have a 401k, we've done this in the past where we want someone to be more aggressive in their 401k investments, but they don't want to take their huge lump sum and make it really aggressive. So what do? You have your balance of your 401k, what you already have in there, remain conservative or however you like it, but your contributions going in bi-weekly or whenever you get paid, make those aggressive. Why? Because if the market goes down, great, I'm buying the aggressive stuff that will recover when the market recovers. If the market's going up, at least I'm buying the stuff that's going up the most, right? So it's a little way that even in a 401k, you don't have to just change your balance of your investments. It could be what you're going into in the form of dollar cost averaging that could skew the amount of risk you have in your portfolio.
Yeah, we do that quite often. And in fact, the dollar cost averaging from a mathematical phenomenon perspective works better when you have something that has a lot more volatility.
Yes.
Because, if it's $10 a share and it might go to 10.01 or 9.99, the math behind it doesn't change. But if it goes from 10 to 15 to 750, then it really shows its weight that way. Last question for this episode. Oh, what a beautiful lead on.
Yeah.
All right. What are the tax implications of my investments? Great question. And I think what we'll do is we'll talk about it from the perspective of it depends on what type of account that you have it in.
Yes.
So for all intents and purposes, there are 3 different types of accounts. You get your pre-tax, which is like your 401k and your IRA. You got your post-tax, which is your Roth IRA or your Roth 401k. And then you got your non-qualified, which is your regular investment account. So on the pre-tax side, if I put $10,000 in, I got a tax deduction. When I take the money out, I have to pay taxes on it later. With a Roth IRA or Roth 401k, I put $10,000 in, I didn't get a deduction. When it comes out, I don't have to pay taxes on it. Of course, got to meet certain criteria, over 59 and a half and 5 years in the account. But aside from that, the non-qualified investment, which I don't want to say is more common, but it's trickier, is that if I put $10,000 into an investment and it grows to 15, I have to pay taxes on that 5 when I sell it.
Yeah.
And
most Americans have a non-qualified account. It's called your bank account. If you own a home, that's a non-qualified investment in that if you earn interest in a bank account, you'll get taxed. You buy a stock for $1,000, you sell it later for $2,000, you'll get taxed. If you lose money, you get to actually write it off. So there's going to be a lot more to dive into that because there's a lot of complexities in there, but the most common form of a non-qualified account is simply a bank account. Your home is a non-qualified type of investment. You buy it for $500, some complexities in here. You sell it for $1.5 million, you're going to have to pay taxes on it. The Roth, the after tax, once you get it in, go baby go. That's tax-free for the rest of your life. That's where you want to be aggressive. And the tax deferred is anytime you take distributions from the account is when you'll get taxed, as you mentioned.
And lastly, as it pertains to the capital gains on your investments, so your investments may distribute dividends. Dividends are taxed a certain way. The interest in your savings account is taxed a certain way. But then when you're talking about your investments and you sell it at a capital gain, then you have to differentiate between short-term capital gains and long-term capital gains. Long-term capital gains are greater than 1 year or a year and a day. Greater than 1 year is a long-term capital gain, which gives you a better tax rate than a short-term capital gain, which is a year or less. So there's a lot that goes into it. And interestingly enough, I haven't looked at the questions, but the next episode that we're going to be doing is on tax planning, and chances are this topic's going to come up. So, hope you learned something in these 2 episodes on investments and investing and investment planning. And thank you for joining us. And we'll be back with you in the next episode of Financial Planning Explained. We'll be talking about taxes and tax investing and tax planning. So thank you for joining us. Have a wonderful day.